Oil prices just surged over 7% on Friday following Israel's unprecedented attack on Iranian nuclear and military targets. The DAX crashed 3.24% for the week, extending its losing streak to 6 consecutive days, and S&P 500 dropped below the psychological 6,000 points level. But here's what the markets didn't expect. Iran immediately struck back, followed by Israeli attack on military targets early today. Hi everyone, this is George, and today is Saturday, the 14th of June, and based on the latest developments, I have created 3 critical scenarios for the Israeli-Iranian conflict and their consequences on oil prices and major stock markets. So let's start with where we stand right now. Oil prices surged, as I said, over 7% on Friday, with the Brent crude oil setting at $74.23 per barrel and the West Texas Intermediate at $72.98 per barrel. This represents the largest single-day gain since March 2022, when Russia invaded Ukraine. The German DAX suffered the most severe impact, closing at 23,516.23 points, down 1.07% for the day and marking a substantial 3.24% decline for the week. The DAX extended its losing streak to 6 consecutive trading days, reflecting Europe's heightened sensitivity to geopolitical risks. The FTSE 100 showed relative resilience, declining just 0.4% on Friday after hitting a record high of 8,884 points on Thursday. Meanwhile, the Standard & Poor's 500 fell 1.13% to close at 5,976.40 points, dropping below the crucial 6,000 level and sitting nearly 200 points away from its all-time closing high. So, my first scenario, the good scenario with about 30% probability, assumes that the conflict will be resolved immediately, or at least by next Wednesday. So in this scenario, both Israel and Iran step back from further military action. In this scenario, oil prices would retreat from current elevated levels as the geopolitical risk premium that drove Friday's 7% surge gradually dissipates. Oil prices would likely decline to the $65-70 per barrel range within the next 2 to 4 weeks. Goldman Sachs maintains its longer-term forecast of Brent falling to 59 in the fourth quarter of 2025, assuming no sustained supply disruptions. For the indexes, this would trigger a strong recovery. The DAX could bounce back 2% to 4% in the first 2 weeks as European markets set their geopolitical risk premiums, extending to 4 to 7% gains over the month. The FTSE would see 1.5 to 3.5% gains short-term, with energy sector gains offsetting initial losses, potentially reaching 3 to 6% monthly gains. The S&P 500 would lead the recovery with 3 to 5% gains in 2 weeks, potentially achieving 5% to 20% monthly gains thanks to America's energy independence. Now let's go to scenario number 2, the moderate escalation scenario with a 55% probability. This assumes that Israel and Iran continue exchanging strikes, but both countries simply trade attacks without targeting critical energy infrastructures. Attacks remain focused on military and nuclear facilities rather than oil production capabilities. Here, oil markets would price in a sustained but manageable risk premium. Oil prices would likely stabilize in the $80 to $90 per barrel range over the coming weeks and months. Goldman Sachs projects that ongoing tension could temporarily disrupt approximately 1.1 million barrels per day of Iranian supply over 6 months, pushing Brent to peak slightly above $90 per barrel. European markets would face the biggest challenge. The DAX could drop 3 to 6% in the short term, I mean 2 to 4 weeks, as the European markets face dual pressures from energy costs and proximity to conflict zones, extending to 5 to 10% losses over the month. The FTSE would see mixed performance with 2 to 5% short-term losses as energy gains offset broader market declines, potentially reaching 3 to 7% monthly declines. The S&P 500 would show relative resilience with only a projected 2 to 4% short-term losses, extending to 3% to 6% monthly declines, demonstrating lower regional exposure thanks to energy independence. Now the third scenario. The severe escalation with an approximately 15% probability. This would mean that Western countries, mostly the UK, France, Germany, and the USA, engage in helping Israel with at least its defense or even attacking supplies and help. Under this scenario, it would be highly probable that Iran would close the Hormuz Strait, meaning major disruption for oil supplies. The Hormuz Strait handles approximately 20 to 21 million barrels per day of oil and petroleum products, representing nearly 20% of global oil trade. Multiple analysts project oil prices would surge to $100 to $120 per barrel or even higher. Goldman Sachs warns that oil prices could surpass $100 per barrel in an extreme scenario of prolonged disruption. Lazard Asset Management forecasts price increases upwards of $120 per barrel if attempts are made to close the strait. Under this scenario, the market carnage would be severe. The DAX could plummet 8 to 15% in 2 weeks as European energy dependence creates severe economic disruption, potentially losing 15% to 25% over a month as sustained energy crisis threatens European industrial production. The FTSE would see a 6 to 12% short-term losses, with sharp declines across all sectors except the energy producers, extending to 12 to 20% monthly declines. Even the resilient Standard & Poor's 500 wouldn't escape facing a 5 to 10% projected short-term losses and 10 to 18% monthly declines as global recession fears intensify despite US energy advantages. So, what I believe is that right now we must first sit on our hands and wait, primarily what is going to happen tomorrow with the US-Iranian conversations regarding Iran's nuclear program. If, of course, these conversations take place eventually. Then we have our 3 signals and what would they mean for the markets. I will keep you updated for latest analysis here or on my X account, which you can find down below in the description. So do not forget to subscribe to not miss anything. See you all on Friday, where I will analyze the impact on Fed's interest rate decision and economic forecasts. See you all. Bye-bye.